So first up, blockchain. So what is it? A blockchain is a digital ledger, kind of like a record book or database. But instead of being stored in one central place, like on a company's server, it's spread out across many computers around the world. And these computers are called nodes. Imagine it like this. Each time something happens, like a transaction, a new block of information is created. This block gets added to a chain of previous blocks, forming a blockchain. But here's a key difference. Once information is added to a blockchain, it can't be changed or tampered with. It's locked in place, creating a permanent, unchangeable record. So in short, blockchain is a secure, decentralized way of storing data where everyone can see the transactions, but no one can easily change them. That's why people say blockchain is trustless. It removes the need to trust a middleman like a bank or a government to validate transactions. So let's break down how blockchain technology works using this simple diagram. Step 1. A transaction is initiated. It all starts when a new transaction, let's say some data, a payment or a contract, is created and added to the blockchain system. This transaction can be initiated by any user in the network using a computer or device. Step 2. A block is created. So once the transaction is initiated, the system generates a block to represent this new data. A block is essentially a digital container that holds the transaction details, such as who's involved, the amount, and a timestamp. Next, we have the block is broadcasted to the network. So after the block is created, it's broadcast to all nodes or computers in the network. These nodes are participants in the blockchain network, and their job is to ensure that everything in the block is legitimate. Next, we have nodes that validate the block. So now the network of nodes goes to work. Each node in the system reviews the block and decides whether the transaction is valid or not. This process is known as validation or consensus. Depending on the blockchain system, this could involve methods like proof of work or proof of stake. And then we have the transaction being approved. Once the majority of the nodes approve the block, the transaction is verified. This approval means the network agrees the transaction is valid and hasn't been tampered with or duplicated. Here we have the transaction being approved. So once the majority of the nodes approve the block, the transaction is verified. This approval means that the network agrees the transaction is valid and hasn't been tampered with or duplicated. And we have the block being added to the blockchain. So after approval, the block is permanently added to the blockchain, which is a chain of previous transactions. This is what makes blockchain secure. Each block is linked to the one before it, creating a tamper-proof record of every transaction that's ever occurred on the network. And I guess the final step, the transaction being complete. Once added, the transaction is now permanent and immutable. This means it can't be changed or deleted, and it becomes part of the public record on the blockchain. The data is locked in and can be accessed by anyone in the network. In short, blockchain works by allowing users to add transactions, which are then verified by a decentralized network. The approved transactions are stored in blocks that are connected in a chain, making them permanent and secure. This technology ensures transparency, security, and trust in systems ranging from cryptocurrencies to smart contracts. Well, let's dive a little deeper. Each block in a blockchain contains 3 key pieces of information. Number 1, the data itself, like a transaction. Number 2, a timestamp of when the block was created. Number 3, a unique digital fingerprint called a hash that identifies that specific block. Each block contains the hash of the previous block, linking them together in a chain. That's what makes blockchain so secure. If you tried to change one block, you'd have to change every block before it, and that's practically impossible because of the decentralized network of computers or nodes keeping track of everything. So think of blockchain as a digital notebook that anyone can view but no one can change. Moving on. So what is cryptocurrency? A cryptocurrency is a digital or virtual form of money, but unlike dollars or euros, which are controlled by central banks, cryptocurrencies are decentralized and use blockchain technology to operate. The most well-known cryptocurrency is Bitcoin, but there are thousands of others like Ethereum, Ripple, Solana, BNB, just to name a few. Each cryptocurrency operates on its own blockchain, and they can be used to buy things, invest, or even power decentralized apps, something that we'll get onto in future videos. Cryptocurrencies are stored in something called a digital wallet, and you can send them to others just like you'd send an email. But instead of a bank verifying the transaction, it's the decentralized network that confirms it. This is called mining. So how does cryptocurrency work? When you make a transaction with cryptocurrency, your transaction gets grouped with other transactions into a block. Before this block is added to the blockchain, it needs to be verified. This process is known as mining. Miners use powerful computers to solve complex math problems that verify transactions. Once they solve the problem, they add the block to the blockchain and get rewarded with new cryptocurrency. This is how new coins are created. So in short, cryptocurrency is built on blockchain technology and uses this decentralized system to operate, making it independent from banks or governments. Let's break down how cryptocurrency works using this simplified diagram. The transaction begins. It all starts with the user making a transaction from their digital wallet. This wallet is like your personal bank account, but for cryptocurrency, and is secured by a private key. The private key is what authorizes you to send funds. Step 2. The transaction is broadcast. So once the user authorizes the transaction, it gets sent to a decentralized network. This network is made up of nodes, which are computers or servers distributed globally. These nodes are responsible for verifying and validating the transaction. Step 3. Validation by nodes. The nodes on the network, also known as miners in proof-of-work systems like Bitcoin, or validators in proof-of-stake systems like Ethereum 2.0, receive the transaction. They check that everything is correct, like whether the sender has enough funds and if the transaction follows the rules of the network. These nodes then work to confirm the transaction. Step 4. Transaction is added to the blockchain. So once validated, the transaction is added to a block, which is then linked to a blockchain. The blockchain is like a digital ledger, recording every transaction ever made on the network. It's permanent and can't be altered. Next, we have reward and transaction fees. So we can look at these simultaneously. For their work in validating the transaction, miners or validators receive a reward, usually in the form of newly created cryptocurrency. At the same time, a transaction fee is deducted from the user who initiated the transaction. This fee compensates the network for processing the transaction. And the final step, confirmation. So after the transaction is successfully added to the blockchain, it's confirmed. The recipient of the transaction can see the confirmed amount in their wallet, completing the process. In summary, cryptocurrency transactions rely on a decentralized network to verify the record. In summary, cryptocurrency transactions rely on a decentralized network to verify and record transactions securely. This system operates without the need for a central authority like a bank, and the blockchain ensures transparency and security through the process. So why do people actually care about cryptocurrency? Cryptocurrency is popular for a few big reasons. Number one, it's decentralized, meaning no single entity like a bank or government controls it. Number two, it allows for borderless payments. You can essentially send money to anyone, anywhere in the world, without relying on traditional financial systems. It's also an investment opportunity. Cryptocurrency, like Bitcoin, Ethereum, have seen massive price increases since they were launched. For example, Bitcoin was worth just a few cents when it started in 2009, and today it's worth thousands of dollars. Cryptocurrencies are also used for things like smart contracts, which are automated agreements that run when certain conditions are met, making them more than just digital money. They have real-world application in finance, insurance, supply chains, and even voting systems. So the risks and challenges of cryptocurrency. It's not all sunshine and rainbows. Cryptocurrencies can be extremely volatile, meaning their value can rise and fall dramatically in a short period of time. Plus, since cryptocurrencies aren't regulated like traditional money, there's higher risk of fraud, scams, and hacks. So if you're thinking about investing, it's important to do your research and be cautious. And since cryptocurrency transactions are often irreversible, if you make a mistake or get hacked, it's tough to get your money back. That's why security plays a huge role in this conversation. So what's next for blockchain and cryptocurrency? While some people think it's a fad, others believe it could revolutionize industries. Blockchain technology could transform sectors like finance, healthcare, and even supply chains by making processes more transparent and efficient. Cryptocurrency, on the other hand, could either become a common way we handle money, or it may stay a niche investment opportunity. Either way, the underlying technology, blockchain, looks like it's here to stay. So there you have it, blockchain and cryptocurrency explained in simple terms. Whether you're just curious or looking to invest, it's always important to understand the basics before diving in. If you found this video helpful, give it a thumbs up, subscribe for more content like this, and drop your questions or thoughts in the comments below. Thanks for watching.